Hi, everyone. Thanks for joining us today. This is Allison Dwyer with CQG, and it's my pleasure to introduce Jim Wyckoff. Jim has over 30 years experience with the stock, financial, currency, and commodity markets, and hopes everyone can take away several valuable concepts during his presentation today, which will be covering major market fundamentals, trading tactics, and educational elements. If you do have any questions during the webinar, please enter them into the Q&A off to the right-hand side, and we will answer them at the end of the presentation. And without further ado, I will turn it over to Jim.
Thank you, Allison. I guess it has been over 30 years. In fact, I was just thinking today, it's been 33 years that I've been covering trading and analyzing the markets, including in the mid-1980s having a relationship with CQG. So it's nice to be back with CQG again. They're a respected data firm throughout the world, and so we'll get started here. We're going to take a shorter term and longer term, mostly technical, but sometimes fundamental perspective on key futures markets. And you picked a good day and a good webinar to attend, I believe, because just at the beginning of this year, in 2018, I've seen some very important developments in the currency markets, in the bond markets, and in the commodity markets that suggest a major shift could be occurring and is likely occurring. In my years of covering the commodity and financial markets, especially the commodity markets, I've seen a very cyclical nature in the markets. We tend to go through boom periods in commodities and bust periods in commodities, and they're very well pronounced. And I think we're just ending a bust cycle in the raw commodity sector and just entering a boom cycle. It's always fun in my business to be in the midst of a boom cycle in commodities, because most traders and market watchers like to be bullish and like to see price uptrends. So as we go through the webinar today, I'll point out some key elements to you that make me suspect and strongly believe that we are embarking upon a boom cycle in the raw commodity sector. Here's a disclaimer that I would encourage you to read when you get some time. And by the way, if you'd like a copy of this presentation, send me an email at jim@jimwyckoff.com, and I can attach that and email it back to you. I'm going to be showing you some daily charts that I created yesterday, along with some weekly charts with support and resistance lines on them that are important levels that you'll want to watch throughout the next few weeks. So here we go. We're going to start out by taking a look at the daily charts, daily bar charts, starting out with the U.S. dollar index. And as you can see on the daily chart here for the dollar index, we've seen prices in a solid downtrend, and just recently in an accelerating downtrend. In fact, just today the dollar index hit a more than 3-year low. And we did see a bit of a rebound this afternoon when reports came out that President Trump said that he does indeed favor a stronger dollar. So that popped the dollar index off of its lows, and right now, as I look at my price screen, we're trading slightly higher in the dollar index. Nonetheless, the dollar index was due for a corrective bounce, and I think President Trump's comments really probably aren't going to impact the dollar index or the currency markets on a long-term basis. The markets were just due for a correction after this steep price action we've seen on the upside in the euro and other currencies, on the downside in the dollar index. Now, one of the reasons that I'm so excited about rallying commodity markets here in the next few weeks or few months and even longer is the fact that the dollar index has been trending sharply lower. Most commodity markets on world markets are priced in U.S. dollars. And when the U.S. dollar depreciates, that makes those commodities less expensive to purchase in non-U.S. currency. So the fact that we're seeing a sliding U.S. dollar suggests that foreign buyers of raw commodities are going to be paying less, and that means more demand for those commodities. Looking at a weekly chart for the U.S. dollar index, you can see that prices are also in a longer-term downtrend. And again, note these important support and resistance lines seen here on the dollar index chart. Let's take a look at the euro currency. The euro currency futures market is one of the most actively traded markets in the world. Very liquid, as are most of the currency futures markets. We can see here on the daily chart for the euro currency that prices are in a solid uptrend, and just today hit a new 3+ year high. So as you can see, the euro currency and the dollar index trade in just about the opposite fashion. Looking at the weekly chart for the euro currency, we can also see prices have been trending higher since late 2016, just hitting that 3+ year high. Note the support and resistance lines on the chart. The reason I like to show you these longer-term charts is that history proves that trending markets tend to gravitate toward historical highs and lows. So if you have at your disposal some longer-term price charts to examine, and the market that you're following is in a strong trending mode, you can see those support and resistance levels on those longer-term charts to give you a better idea where that trending market may pause or may stop, or or if it pushes through a support or resistance level, then the trend may even accelerate. Taking a look at another very popularly traded market, the E-mini S&Ps, and we can see here on the daily chart that prices are in a strong uptrend. Very mature bull market run here in the stock indexes. Those that have tried to pick a top have been brutalized, and the market just keeps trending higher. The one thing I will point out is that with the recent clues that I've seen regarding a rebound in the commodity sector, in the raw commodity sector, that is a bearish outlook for the paper assets like stocks and bonds. So as we continue to see, which I believe is going to occur, an upturn in the raw commodity sector, that the clock is ticking, I believe, on the bull market run in stocks. And let's take a look at the weekly chart for the E-mini S&P. We can see that prices are also in a longer-term uptrend. I really don't see any strong chart clues to suggest this uptrend is going to end anytime soon. However, I will point out, as seen at the bottom of the chart, that the relative strength index reading right now for the E-mini S&Ps on a longer-term basis is 92.2. That's the highest reading. Any reading above 70 on the RSI, some would say 75. I say any reading above 70 on the RSI is an overbought reading, and we're reading 92.2, which is really an extremely overbought level basis, the RSI. And going back several years and maybe even a few decades, I have not seen the RSI be at such a high level. That's another indication this is a very long in the tooth bull market run here in the stock indexes, and certainly at the very least due for a decent downside correction soon. Taking a look at the NASDAQ daily chart, much the same situation, a solid shorter-term price uptrend in place. Weekly chart on the NASDAQ also shows a solid longer-term price uptrend, but again, the RSI reading on the weekly NASDAQ is 85.79. That looks like it's about the highest level in several years at the very least. So again, a very overbought market that's due for at least a downside correction. Take a look at the daily chart for March UST bonds. Prices are in a downtrend and have just hit a contract low this week for the bonds. Lower bond prices means rising yields. It also means rising interest rates. It also suggests rising inflationary pressures. All those factors also suggest a move toward hard assets, such as raw commodities, as opposed to paper assets. So in looking at the bond market and seeing how prices are trending lower on a near-term basis, that's also a warning signal for the stock indexes. Looking at the weekly chart for nearby U.S. T-bond futures, we can see that prices have also been trending lower from last year's high. If we drop below that support level, I have drawn on the weekly chart at 147.7, that's basis nearby T-bond futures. That's going to produce some more serious chart damage to suggest a real solid leg down in prices in the coming weeks. It is my bias that we will penetrate on the downside that support level to produce more damage and see more selling pressure. In fact, you can even look at this weekly chart on T-bonds and the three peaks, the three peaks you can see there on the chart recently have formed a bearish head and shoulders top reversal pattern that also is an indicator that the prices will see some more downside action here in the coming weeks. So again, the bear market in bonds and notes presently is another indicator that the money is flowing out of paper assets and into the hard assets like gold and some of the other raw commodities. Weekly chart on U.S. 10-year T-note futures, pretty much the same situation. New contract low this week, prices in a near-term downtrend. And I'll point out at this time also that you'll note I talk a lot about price trend. In my 30-plus years in the business, it's just become very apparent to me that the most important element in your trading strategy needs to be identifying the price trend in your trading time frame. Whether you're a position trader and you look at daily charts, or a long-term trader and you look at weekly charts, or if you're an intraday trader that looks at intraday charts, you need to know and identify your existing price trend in that time frame. Weekly chart on U.S. T-notes also shows prices trending lower from last year's high. If we drop below support at 121.24 basis nearby futures, that's going to produce more chart damage to suggest more downside price pressure, and that is my bias. We're going to take a quick look at weekly charts for the currency futures traded in Chicago. Starting out with the Australian dollar, we can see that prices have been trending higher the past several weeks. And I believe just this week, I created this chart yesterday, and today we may have even poked above that previous 2017 high, and if we haven't, we're close to it. It is my bias. We will punch above that level, and then the next resistance level is at the 82.50 level basis nearby futures. It's important to point out this currency price action we've seen just this week with more extreme price moves and new multi-year highs set in some currencies along with the multi-year low in the U.S. dollar index. These are powerful trending price moves that are starting to unfold. Longer-term price history shows that trends in the currency markets tend to be stronger and longer lasting than trends in other markets. So the fact that these currency markets are starting to trend suggests they're going to trend for quite a while longer, and that is also a bullish element for the raw commodity sector because it suggests a continuing weakening of the U.S. dollar as well as a rise in inflationary pressures. Weekly chart on the British pound, look at that solid price uptrend that's been in place since early 2017. New multi-year high in the British pound just this week. The trend is up. The trend is your friend, so the saying goes. Weekly chart on the Canadian dollar also shows prices starting to trend higher, but we need to overcome longer-term chart resistance at 82.80 to suggest that this market can really start to run on the upside. It's my bias that resistance level will be challenged in the coming few weeks. Now, one question you may be thinking is that with these currencies trending so strongly, have I missed the move? Is it too late to jump in on the long side here of a position trade or a trade in the currency markets? My answer to that would be no, it's not. As I said, trends in the currency markets tend to be longer lasting. One idea would be if you are thinking about a long position or long side trade in the currency market, wait for a corrective pullback, a decent corrective pullback in an uptrend. Markets don't go straight up or straight down. They always find corrections and backing and filling. And when you see a downside, if you're thinking about getting long and you're bullish a market, wait for that market to see a downside correction, and then you can enter on the long side so you're really not chasing the market. Weekly chart on the Japanese yen shows prices have also seen a solid rebound this year, but we've got some stiff overhead resistance here as seen on the chart. This is probably the most important chart I want to show you today. This is the weekly chart for the Goldman Sachs Commodity Index. It's a basket of several major commodities rolled into one composite price index. And as we can see here on the weekly chart, the GSCI has been trending higher since early 2016 and just this week hit a multi-year high dating back to 2014. This suggests that the raw commodity sector is gaining power, led by its leader, crude oil, and it also suggests that the year 2018 and maybe beyond is going to see much better times as we move into the boom cycle in the raw commodity sector. Speaking of crude oil, let's look at the daily chart for NYMEX crude. Price is in a solid near-term uptrend, just pushed above $66 a barrel today. Look at the weekly chart on NYMEX crude. We can see that prices are also in a solid uptrend, just hit a 3+ year high. So these charts I'm showing you on these commodity markets, they are indeed starting to trend higher both on a near-term and a longer-term basis. And when you look at these weekly charts, note the previous highs dating back 4 or 5 years. The fact that we are in many times fledgling price uptrends on the weekly charts suggests that there's a lot of room to run on the upside when you look back at where prices were 3, 4, 5 years ago. The one fundamental element that I will point out in the crude oil market that gives me pause on this rally, I don't ignore fundamentals. I focus mainly on technicals for entry points in trades and such, and for price trends and such, but I don't ignore the fundamentals, and neither should you. I'm not suggesting anybody become an expert on the fundamentals in their market, but at least know the main fundamentals. The thing that worries me about the crude oil market at present is that with prices above $60 a barrel, you're seeing a significant ramp up in U.S. shale production. Fracking is called, and I suspect that's going to continue, and the fundamental side of me says that as prices approach $70 a barrel in crude, you're really going to see that production ramp up, and that could very well cap the upside in the crude oil market. But from a purely technical perspective, we've got a solid price uptrend going in the crude oil market with no early chart clues that a market top is close at hand. Natural gas market is also starting to rebound. This market has been very choppy lately. We've got an uptrend in place on the daily chart here we see on natural gas, but when we look at the weekly chart, price action had been choppy and sideways, and we've just recently seen a bullish upside breakout, as seen here on the weekly chart, to a new multi-month high in the natural gas market to suggest that we have put in a market bottom here a few weeks ago, and we've got more upside in the natural gas market. This is a good example also on trading strategies. One of my favorite trading strategies is to see a market that's been in a congestion area. And as you can see here on the weekly chart, natural gas, most of 2017 prices were trading sideways. Remember that a market can trend really in 3 directions. It can trend up, it can trend down, and it can trend sideways. And it can be even argued that most markets, most of the time, are trending sideways. As seen here on the natural gas chart, we've seen a bullish upside breakout from this sideways trading pattern, and that suggests there's still more upside price action to come. When I look at a daily chart and I see a market that had been trending sideways and let's say an upside or a downside breakout occurs, those are trading opportunities in the direction of the breakout. So if I were looking at a daily chart for natural gas and saw this upside breakout, that would be a clue that this might be a good long side trade. So keep in mind when we're examining your charts for those congestion areas and then price breakouts. That's one of my favorite trading strategies. Let's look at the gold market. Solid price uptrend on a near-term basis in gold. Today we hit a new 4.5-month high in the gold market. After the gold market closed the New York day session, we did see prices back off on some profit-taking and following President Trump's comment that he wanted to see a stronger dollar. I really don't think that Trump's comment is going to have any lasting impact on the gold market. Really, it was just a corrective pullback today, this afternoon, that was overdue after recent solid gains. Looking at the weekly chart for the gold market, we can also see prices are in an uptrend, just poised here to push above that 2017 high, and then we've got some more resistance at the 2016 high, but the price trend is up. And again, look at prices where they were in 2012, 2013, well above $1,600 an ounce. So if this market does continue to trend higher, pushes above longer-term resistance as seen on this chart, then you've got much more upside price potential. Again, a real good idea for the chart for the market that you're interested in trading. Look at these longer-term charts to see if the market does start to trend strongly. See how far that market can run before it runs into some longer-term chart resistance or support at the historical highs or lows. Silver market this week has seen a bullish upside breakout from a congestion area. That's a bullish near-term clue suggesting more upside price action in the silver market. Silver also likes to follow the gold market. Silver has been called poor man's gold because it is cheaper to purchase, but yet still does have a safe haven allure to many investors and traders. And look at this weekly chart for silver. This is a classic example of a market that's been trading in a sideways range at lower levels for looks like about a year and a half. If we see an upside breakout by prices pushing above resistance at 1865, then this market looks like it has much more room to run on the upside from a longer-term perspective. Going back to 2012, 2013, we can see that silver prices were around $30, $35 an ounce, and today we're trading at 17. So this market, history shows that if it wants to start trending strongly, there's a lot of room to run on the upside. Copper market, seen volatile price action here this week. Big losses on Tuesday were followed by big gains on Wednesday, and then we just saw some consolidation today. I do give the overall near-term technical advantage in the copper market to the bulls. And then seen here on the weekly chart, the copper market is in a choppy price uptrend since 2016. Copper is an important industrial metal. The fact that copper prices are trending higher suggests world economies are gaining strength. Let's take a look at the international foods market, starting with sugar. Sugar prices in a solid downtrend on a daily basis. On a weekly chart for sugar, we've got prices are moving toward the bottom end of this trading range. Here's another trading strategy. It's called swing trading. If you see a market that is trapped in a range, a well-defined trading range by well-defined support and resistance lines, like seen here on this sugar market, as prices are moving down toward that solid support level at 12.50 cents, a long side trade might be initiated on the notion that strong resistance or strong support level is going to hold and prices are going to rebound into the upper part of the trading range, as has happened. As you can see, as prices in 2017 dropped down to close to that 12.5-cent level, they did rebound and push back up into the upper part of the range. So as prices move into the lower part of the range, as they have, it could be implied that the selling pressure is going to halt and that buying is going to enter the market and push prices back up at least into the upper part of the trading range. That's called swing trading. That's one of my favorite types of trades also. Coffee market daily chart, prices kind of trading choppy the past couple of weeks at lower levels here in the coffee market. Weekly chart on coffee also shows prices in a longer-term downtrend. However, these international food markets that have been beaten down, I suspect that if we continue to see crude oil holding above $60, if we continue to see the U.S. dollar index weaken and continue to see gold and silver rally, you're going to see these international foods markets bottom out and start to see some buying interest step in also. And this includes the grains. We're going to get to the grains shortly, but a lot of these beaten down food markets are, with their present price levels, are value buying opportunities from a longer term perspective. Cocoa market trying to trend higher in choppy fashion on a daily chart. Looking at the weekly chart for cocoa, we can see that prices have bounced off some strong longer-term chart support at 2017 lows, suggesting that we're probably going to trade back up into the upper portion of that choppy trading range. Cotton market is the international foods markets that's the star right now. It's in a strong price uptrend, scored a new contract high recently. More upside likely. Weekly chart on cotton also shows prices in an uptrend. We've got some strong resistance at the 2017 spike high of 87 cents. If we push above that level, you're looking at a challenge of $1 a pound here in 2018. Orange juice market. Starting out 2018 in good fashion with the price uptrend. We've seen some cold weather and ice down in the southeastern U.S. citrus regions that's prompted some damage concerns, and that's been the main reason you've seen the OJ market pop here early this year. We're still not out of this winter season here in the U.S., and there still could be some more damaging cold weather down in the citrus regions, and you could see more upside if that occurs. Weekly chart on orange juice shows prices have bounced off of after approaching the 2017 lows. Note the support and resistance lines on the chart. Lumber market's been screaming higher recently, scored a new contract and multi-year high recently. See here on the weekly chart for lumber, the prices are also in a solid uptrend. Lumber is a thinly traded market. There are more limit price moves in the lumber market than any other market traded. I used to follow pork bellies when they were a futures market, and the pork bellies and lumber were the two most volatile markets on a daily basis. And with pork bellies out of the picture, lumber has that moniker all to itself now. Take a look at the livestock market, then we'll move on to the grains. Live cattle prices have seen a solid rebound from the 2018 low, or from the January low. And just today, though, we saw a big downside reversal in the cattle market that has somewhat dented bullish enthusiasm. Still, we've got a short-term price uptrend in the cattle market in place. Weekly chart on cattle shows prices are still trending higher in choppy fashion from the 2017 low. Lean hogs, choppy price uptrend in place, not far below the recent contract high. And then the weekly chart on hogs also shows prices are trending higher from the 2017 low. Let's move on to the corn market. I know there's probably a bit more interest in the grains than many other markets. The corn market had been languishing at lower levels, and just this week has seen a pop to a new multi-week high. It is my bias that the grain markets have put in market bottoms. We are heading into, well, let's put it this way. In the coming months, we're going to be starting the planting and growing season for U.S. corn and soybeans, and the wheat harvest is occurring. And those are times when the grain markets heat up in volatility. Nearly every growing season in my 33 years in this industry have seen some degree of a weather market scare in the corn and soybean market, and also the wheat market to a lesser degree. One favorite trading strategy among a lot of traders is to, at this time of year, typically when grains are low in volatility, maybe even in downtrends, and just like this year, you know, not far from recent lows, they like to buy a call option on, say, July soybeans or corn, or even December corn and November soybeans, on the presumption that there is going to be some degree of a weather market scare occurring in the growing, in the planting or growing season, and that indeed usually does happen. In fact, I think there's just a few years ago there was one season where we just had a perfect, nearly perfect growing season in the U.S. Corn Belt that really didn't produce much of a weather scare. But that was really an anomaly. Most years you do see some kind of a serious weather market scare that pops grain prices, even if it's only temporary, and if you have a call option, you're just sitting there waiting for that very likely price action to occur. The nice thing also about buying call options in a market that has low volatility is you're not going to pay a high premium based on the higher volatility that would be in place if the markets were more active. Weekly chart on corn also shows a kind of a sideways trading range the past several weeks. Got to break corn prices, nearby corn futures prices out above 358 to give the bulls some longer-term technical momentum to suggest a price uptrend can be sustained. It is my bias that corn prices will trend sideways to higher this year. Soybeans have really seen a nice pop here the first month of the year, including hitting a multi-week high. We pushed above $10 just today in March soybeans. The weekly chart on soybeans also shows prices trapped in a sideways range. Going to have to push nearby prices above 10.27 3/4 to produce a bullish upside breakout on the weekly chart. My bias is that will happen. And then finally, looking at the wheat market, we've seen a pop in the wheat market here this week. If the corn and soybean markets are going to start to rally, wheat is going to follow. Weekly chart for soft red winter wheat, which is the most actively traded futures market, shows kind of prices chopping at lower price levels. And with that said, Allison, I'll take any questions on any trading strategies, any markets that listeners may have.
Okay, great. Thank you. I don't see any right now, but let's wait a few minutes, see if anyone has some questions.
Sure, sounds good. And also, if anybody has any questions during the month, feel free to email me. I do answer all my emails in a prompt fashion, and happy to correspond with my my readers.
Someone just asked what your trading strategy for intraday is.
That's the great thing about technical analysis, and some of these things I just laid out for you. Even though I was talking about a strategy for a daily chart or something on a weekly chart, you can apply those strategies to intraday price action. So if you're looking at, let's say, a 5-minute bar chart, and you see a congestion area on the 5-minute bar chart, and you see an upside breakout on the next bar, then that certainly constitutes a bullish upside breakout that is just as significant as one seen on a daily or a weekly chart per your trading time frame. So the great thing about the trading or the technical patterns I've shown you today, they can be applied to any trading time frame. Same way with price trends. You can look at a 2-minute or a 5-minute intraday bar chart, and you can see price trends occurring. You can see breakouts. You can see head and shoulders tops. You can see the same types of formations that you see on daily, weekly, and monthly charts.
Okay, and another question is, what is the congestion area that you mentioned?
Well, congestion area is kind of a sideways, the trading bars, the daily, the time period that you see, which most charts I have or look at are daily and weekly charts. But for example, on a daily chart, if you see several days in a row of sideways trading where the bars are just kind of moving sideways and not trending up or down, that forms a congestion area for which price breakouts can occur, either on the upside or the downside. And it's those breakouts, when they occur, that are important trading opportunities.
Okay, and do you have any strategies on trading E-mini Dow futures?
You know, that they would be the same strategies as for the E-mini, S&P, and NASDAQ. Again, I think the Dow, like the other stock indexes, it's been a strong bull market run. Those that have tried to pick tops in the market have been burned. However, it's just a very mature bull market, and my worry would be that jumping on board the long side at this juncture might be, the market is just ripe for a downside correction.
Can you explain more on crude long-term with dollar?
The crude oil and the value of the U.S. dollar tend to trade in opposite directions. That doesn't occur 100% of the time, but if the U.S. dollar continues to weaken, it's very likely that's going to be a supportive factor for the crude oil market. Again, crude oil prices are in a near-term and longer-term uptrend. I don't see any clues to suggest those trends are going to change anytime soon. But again, I'll point out that fundamental I mentioned earlier, the rising U.S. production could cap serious gains in the crude oil market here in the coming few weeks or few months.
Okay, I have another one. Apart from trend lines, which are the most useful signals you use?
That's a good question. Trend lines are indeed the most important, but when I came into this business in the 1980s, computers were just in their infancy as far as trading charts and programs. So I got my charts in the mail every week and had to draw trend lines by hand and such, and look for chart patterns just by looking at a piece of paper, hand-drawn chart. Those are my most powerful trading tools, those trend lines, head and shoulders tops, triangle patterns. There's a good book by John J. Murphy called Technical Analysis of the Futures Markets. If anyone's interested in learning more about basic chart patterns and other technical studies, that's a good book to take a look at. It's available on Amazon.com.
Okay. Is there any specific way you handle the quick reversals?
Quick reversals can be problematic. For example, they do occur just like in the cattle market today, or just like in some of the currency markets when President Trump made that comment on the dollar. The way you can avoid getting whipsawed by markets like that is to use tight protective stops. there's, stops are not a perfect money management tool, but it's pretty darn good because you know where you want to get out of a market before you get into it, and that's always a good thing. There's an old saying that one of my mentors told me one time. He said, any fool can get into a market, but it's the real pros that know how to get out.
Okay. It looks like we don't have any other questions coming in. So I want to thank everyone today for joining us, and thank you, Jim, for presenting and giving us some insight on everything. If anyone missed anything during today's webinar, the recording will be sent to the email address you registered with, or you can view a recording on CQG's YouTube page. If you do have any follow-up questions, though, please feel free to reach out to your CQG representative. Or Jim, would you like to give your email one last time?
Yeah, it's jim@jimwyckoff.com, and my website should be on the little registration form. It's www.jimwyckoff.com.
All right, perfect. Do you have anything else, Jim, or are we good?
No, I look forward to next time. Thanks for tuning in.
Thanks, everyone.
Bye-bye.